Good morning, and thank you for joining us again for the third session of the Living to 100 Symposium. We'll get started by thanking our sponsors again, our gold sponsors, AARP and Milliman, and our bronze sponsors, January, Hanover Re, and NMG Consulting for their support. A special thanks as well to all the many volunteers that hopefully you've encountered, some of them, and to the presenters that make this presentation and this symposium possible. Now I have the privilege to introduce Ronnie Klein, a fellow of the Society of Actuaries and a member of the American Academy of Actuaries. He has 40 years of insurance and reinsurance experience, having lived and worked in 3 countries. He is the executive director of the Bermuda International Long-Term Insurers and Reinsurers, BELTER, and a collaborating expert in health and aging for the Geneva Association. Today, he will discuss the insurance industry's response to the worldwide aging crisis. Please help me in welcoming Ronnie.
Morning. Before I start, I just wanted to thank the Society of Actuaries for inviting me here, specifically Renora. Thank you very much for the invitation. My good friend Dale Hall, who always very supportive, and Kai, I think, was the one who recommended me. So thanks very much, Kai. So let's see where we are here. Here we go. So let's first start off with a little survey here, and there are prizes for the correct answers. So we are in Disney World. How many people have gone into any of the parks so far? Anybody? Not that many. You know, when you get the Society of Actuaries meetings, you get no responses because those people are actually in the park instead of in the session. So, raise of hands. No social media. No, electronics on this one. How many acres are there in Disney World? How many people think it's 110 acres in Disney World? Nobody. Oh, I got a finger. I mean, is that a hand? Yeah. Yeah, so I don't know what to tell you. I don't know what an acre is. 13,000? Rob says 13,000, and he's not from the U.S., he's Canadian. Although, you know, Canada actually is part of the U.S., and I can prove it. I'll do that at the end of this. Anyway, 25,000? A lot more with 25,000. 10 million? Ooh, wow. 2.5 billion? Anybody? 126 billion. Anybody think it's really big? No. Okay, so the correct answer is 25,000. Give yourselves a round of applause for the ones who got it right. Now, what's 110? What has 110 acres? Anybody? Yell it out. I want to hear it. Central Park. That was good. It might be right, but it's actually the Vatican. Did you get it right, Jim? Yes or no? Oh. Here's a chocolate for you. A Swiss chocolate. There we go. Okay, so I want to tell you one thing. It's really nice working in the U.S. because when I do these presentations in Europe and I throw something into the crowd, people go like this. They don't know how to use their hands, right? You know, they want to, kick it or something like that. So, 13,000? Anybody? 13,000? I don't hear anybody responding. Anybody? 13,000? Nobody has a guess for 13,000? Well, it's Bermuda. That's where I work. Nobody said Bermuda, right? Okay. 25,000 we know. 10 million? Anybody?
State of Florida.
The state of Florida? It's a good guess. Or, who said that? Switzerland. Did you say Switzerland? Here we go. There we go. Okay, so that's Switzerland. 2.5 billion. Who said that? That was the first one. Okay, excellent. U.S. That's right. Look at these people just catching everything. And 126 billion, I'm not even going to let you say that's the world. Okay, so let's move on. This is what we're going to talk about today. So this is the agenda. I'm not one who reads slides, so I figure you guys can read. That's it. We're going to talk about this. And I'm going to give you a spoiler alert on this, and that is that when we talk about the industry's response, and Renor says, we want you to talk about the business industry's response. We've had all these academic papers. We want to talk about the industry's response. Spoiler alert, it's not very good. We're going to talk a lot about the problem, and the response is just not very good. I will talk about what's on the horizon, some of the ideas that I have, but the response has not been very good. So let's start with low fertility rates. We don't have that many questions. I think I have 3, so don't think the whole presentation is going to be with it. But which country has the lowest fertility rates? Who thinks it's Spain? And Spain is low. China? Come on, one-child policy, China. Yeah, there we go. Roberto thinks it's China. Yeah, I usually don't disagree with him. Syria? Syria? No? War-torn country? People? No? No. Can't get there. Switzerland, where I'm from? Also low. Okay. Niger? No? Taiwan? A lot of people say Taiwan. That is the correct answer. So it is Taiwan. And I think if I hit this again, it's going to tell you. So they're 188th and 1.22. You might see, now it depends where you have your statistics from. You might see some people that say South Korea. Some charts say South Korea is the lowest. But the one that I looked at said Taiwan, and South Korea was right next to it. But the next lowest, so the next lowest fertility rate, anybody have an idea which one that is? So it is Spain, and then Switzerland. There we go. There we go with China, one-child policy. Of course, we know the one-child policy just recently changed to 2 children. Syria, and then actually Niger is the first. It's the highest rate. So anyway, here are some of the reasons that I personally think a big part of our retirement problem is the low fertility rates. I know a lot of people think it's the aging issue, but we all know that Pillar 1 or Social Security, what they call in the U.S. Social Security, is a Ponzi scheme, right? So the more people that come in, then you can maintain this system. I know I'm a baby boomer. How many baby boomers out there? Yeah, there's a lot. Usually when I do these presentations, not so many. So I'm a baby boomer. When we were in school, all we heard about is there's not going to be enough food to feed the world. We're growing like crazy. It's really bad. Now we're sitting there and saying like there may be no more people on Earth at some point. Well, let's not get too excited. We are still growing as a population projected through the end of the century, but that's when it's going to decline after that. But anyway, I will tell you that I did read. Yeah, here it is. I got an article from the New York Times just, let's see if it has a date on it. It was December 24th. So it's recent, right? So it's recent. And Japan shrinks by 500,000 people. So Japan is already on the decline. Since 2007, the population's been decreasing. And one of the main things is Japan doesn't really like immigration all that much. Switzerland, for example, it has a low fertility rate, but it does have a lot of immigration, so that sort of balances things off. But there are countries that are really, really having problems. Some of the things they state in here, and we'll talk a little bit about that in the problems in Japan, is their reasons for low fertility, and they talk about fewer marriages, that the kids aren't getting married, and they also talk about some of the programs that they're trying to increase fertility, like paternity leave, getting dads to also stay home with the kids. But there's still a stigma. The culture is really important, right? There's still a stigma in Japan with dads staying home with the kids. At-home dads is a stigma. But anyway, here are some of the things that I've heard of reasons why the fertility rates are low. So I wanted to do a little research. So I actually, believe it or not, it's not just all words. I actually did some research and pulled some numbers together on this. And I wanted to put like a chart together. And the only thing I can come up with was something that looked like this. So there you see 20 countries. I wouldn't say they're randomly selected. I picked from different continents and bigger and smaller countries and things like that. And and what you could see, if you can't see it too well, you see GDP per capita is on the x-axis, and the fertility rate is on the y-axis, and the size of the bubble is the size of the country. So now you see this is in 1960. So if fertility rates really are affected by the GDP per capita, as I go through the years, which way do you expect the bubbles to go? So do you expect them to drop first and then move over to the right, or do you expect them to move over to the right and then start to drop, or more of a diagonal line? You'd expect it first. I mean, you can't stop fertility immediately, so you'd expect that there would be some drag to the right before it goes down. Do I get agreement there? Or, yeah? I'm getting some heads shaking yes. So I looked at this, and what I found is I didn't really see that. So if you go into 1970, you see, so let's see if I can go back. So you're seeing a drop, right? So come on, baby. There we go. So you're seeing a drop. Notice that I point to the computer. I don't point to the screen or here, because it works the computer. So anyway, you see that there's a drop. You see the biggest circle, obviously, is China, and the second biggest circle is India, right? So you know that. The US is the third biggest circle, so you see what's going on there. And you see again that it's drop. And here, so that drop in China was before the one-child policy was introduced. And now you see the one-child policy introduced in 1979, and China even drops further. And then you wonder, now you're starting to see them, they've dropped, and now they're starting to move to the right. So there's something else going on here. I'm sure this is part of it, but there's something else going on. I'm not really sold on that it's GDP per capita that's causing the low fertility rates. I'm just not sold on that. And then you wonder, you hear about some countries like France or whatever introducing some public policy, governmental policy to increase fertility rates. We talked about Japan a little bit. It tried to do some of that. Do they really work? And I've heard from demographers that there was one demographer in the group, one or two. I heard that they don't really work that well. But actually, France did it, and there was an increase in France. So there can be some public policy to help with fertility rates. But now, 215 is where I end. You see, the U.S. is just going off the charts on GDP per capita. But look at how many countries are low, dangerously low. I mean, that whole chart, if you remember going back, you see in 1960, everybody above, half the countries and much more than half the population above 5, and suddenly, in 2015, everybody's below 3, right? It's a real problem. But I'm not convinced GDP per capita is the cause. So, you heard more women in the workforce. That's the problem. Not convinced about that either. Look at this. So you have, from 1990 to 2019, exactly 39% all the way through. Okay? So I'm not really convinced that it's more women in the workplace. Now you say, okay, maybe it's not more women in the workplace. The real issue is that women are getting better jobs. That I am. That is something that I really do believe. So if you look here, you see that this is the gender gap. So the gender gap. Here, you sit there and see that it's definitely reducing the gender gap, so women are making more money and have better jobs. And I think this is one of the causes of the low fertility rates. And I will tell you that Taiwan, we showed that Taiwan had the lowest fertility rates. So I happened to have been traveling in Taiwan last year, and had the opportunity to meet up with a couple of CEOs of major insurance companies there. One of them is Fubon Life. Anybody hear of Fubon Life in Taiwan? No? So I met with the CEO there, and he is the father of a few daughters who are doing very well. So this is maybe a little biased, his comments, but his comment, I'm going to read it to you because I had to write it down, the direct quote, which is, he was saying, women can support themselves, they have better jobs, and then his quote was, "Why would a woman lower her standards and get married?" Right? So I think he was probably talking about his own daughters, but it does broadcast a little bit. But I think that is part of it, is that the gender gap is starting to decrease. I will tell you, in the insurance industry, it still has a long way to go. For someone who puts on a lot of presentations and tries to get women to speak, senior women to speak in the insurance industry, I have a tough time finding the CEOs of female CEOs. We have a lot more work to do, but the gender gap is going down, and I think this is one of the causes. So here's what I think is probably the strongest cause, and that's urbanization, right? So people moving to the cities. And as you know, the rural areas would always have higher fertility rates or have more babies than in the cities. There are a lot of reasons for that. It's much more expensive to raise a kid in the city. But really, in the farming areas, families would have a lot more children to help out with the farm. I mean, they needed to help out with the farm. Also, infant mortality rates were higher, and they had more children because they wanted to make sure that they had enough to support them. I've heard, the introduction of Social Security or Pillar 1 reduces fertility right away because people would have, families would have kids to take care of them when they got older, but that whole family model disappeared with Social Security, one of the really bad things about Pillar 1. So anyway, I think urbanization is part. I mean, really what you're getting to here is there's a whole bunch of reasons, and they're all added together, so you can't just attack one of them. One more, and why am I spending so much time on fertility and not aging? I'll tell you that on the next slide when we get to that more, but we spent this whole conference so far talking about aging. So I think the fertility rates, I think that it is much more important. I think that Ponzi scheme, you have to feed the bottom level to help with that. But anyway, this one's clear that first-time moms are getting older. So here it is in 1980. The colors, don't worry about the colors. The colors are actually age groups. So, that dark purple in the chart that I was looking at, the dark purple was ages, till they can start, 13 till 20, and then the colors change. So here it is in 1980, average age about 23, boom, 2016. See that? I mean, that you clearly see that moving off, and women are older, right? Quite interesting. So, I think that is a major issue. I will tell you, there was one person from the Max Planck Institute. Oh, okay. Well, he's not paying attention, so he doesn't get any more press than that. So anyway, there was a study done by Max Planck that said that they think there's a new baby boom coming, that it's just that women are much older, and they're going to have their kids older, and it's coming. It will come. There's no proof of that yet. They are older, but not that they're going to have this. So let's move on. And the increase in life expectancies. This is my only chart on the increase in life expectancies. And the combination, of course, the increase in life expectancy and the low fertility rates is definitely what is causing this pressure on Pillar 1 or Social Security. I'm okay to say Pillar 1 and not always have to say Social Security. You get that, the governmental program. There's a lot of pressure on it. We heard from, I think it was Carl, I don't know if Carl's here again this morning, but I was sitting in a session from Carl Polsner, who was talking about Social Security, and it was a great presentation. And he was talking about all the pressure and how it's going to run out of money and all that kind of stuff. And again, I think it's more the low fertility rates, not the increase in life expectancy, because this is really that, that feeding the Ponzi scheme. I will tell you one more thing. You talk about, the old age dependency ratio, right? You've heard this thing, and how it's going to, by 2050, it's going to be 2 workers per retiree. It's really, going to. I personally think those numbers are flawed. Every major country has increased their retirement age to 67, and they are starting to go up too slowly, but they are going up. But those numbers are always based on, 20 to 64 and 65 plus. And if you just go to, if we can move that number to 70, the numbers change a lot. The old age dependency ratio changes a lot. So I just think we're using an old data source because it's nice to use it every year and it's consistent and everything. But those numbers are changing, and I think we need to change that. And I will tell you, I'm personally concerned about the gig economy. So many people who are working these gigs. That's why it's called the gig economy, by the way. People don't know that. So why is it called the gig economy? It's I'm working at this gig and I'm working at that gig. Sort of that musical terminology. But anyway, so the gig economy, I'm worried about that because then these people are doing small-time jobs and they're not contributing to Social Security or Pillar 2, the workplace environment. So I'm a little worried about that. And then I will tell you one other thing is, we worry a lot about this and we worry about retirement savings. I sat in on the presentation that Anna Rappaport and Sally Haas put together. It was quite interesting. They were talking about polling retirees and things like that. And I've read some studies. Aegon does this great once-a-year retirement readiness survey, which I always read. I find it very interesting. And what you find is, and I did my own survey with Edelman Intelligence, that the pre-retirees are super concerned about having enough assets in retirement. But the retirees are just not as concerned. They're just not as concerned, right? They're not as concerned because they are living their life and they sit there and say, I can change my life to my retirement assets. But the pre-retirees are worried about what's going to happen. So that unknown is always a problem. But anyway, life expectancies, obviously, you could see they're just skyrocketing. The colors, by the way, if you can't read, are just by region. So they're more by continent than anything else. And they're just all going up. So the lowest one, obviously, is Africa. But here's another problem. So just when you think it got bad, it's getting worser. I'm not sure if that's a word, but is the low interest rates. And this is a problem. So I put this little chart together with the help of the Society of Actuaries. Dale, there's some sort of calculator on there where you put, so I used that, so I figured it can't be wrong, right? I didn't want to go pull out my Jordan book and calculate this stuff on my own anymore. So I pulled it out. And remember, these are net, right? So these numbers are net. They're not gross. So whatever I'm showing you here, it's going to be a lot worse, right? There's going to be profit and expenses in there. So I have to give you I'm going to give you a couple of personal stories. I know some of you probably say I've heard them all already, Ronnie, but I have to do it because it relates it to me. So I have a dear friend forever. Donna works for American Airlines in the food. She's on the ground, but she works in like the catering area for years and years. Her husband, Kevin, worked for Nike forever as a sneaker salesman. There's another funny story about that, but I'll tell that another time. But anyway, Donna comes over to me and she says, hey, Ronnie, I got this offer to buy out my old company. They want to buy me out of my pension. It would only be $500 a month, and they're going to give me this lump sum. And I said, Donna, just take the monthly income. And she said, no, let me keep talking. I figured out that I'd have to live to age 88 till it broke even. And by the way, this is how most people think of annuities, right, as an investment. And I'm here to tell you I totally disagree with the way the industry sells annuities. I think it's all wrong. It's not an investment. It's insurance that you won't outlive your assets. That's what it is. It's insurance, but we sell it as an investment. Look how much money you can make. Here's the return you're going to get. Well, that's why I put this chart together. So just, you pay $1 million, that the million could be 1,000, the million could be 10,000. It doesn't matter. They're just round numbers. So you pay $1 million, and here are the different interest rates, and using that annuity table that is on the website that I never heard of, RPH, you guys all know that stuff, but it's just a bunch of numbers to me. But anyway, I use that thing, and here's, how much you would get at certain interest rates. And you see the power of interest, right? So, at 0% interest, you're only getting $44,000 a year, and at 10% interest, you're getting $110,000. I like to look at the 5% interest and the 3% interest, so not that far apart, and how much power there is to it. So anyway, Donna would sit there and say, okay, you're offering me an annuity, and if it's 5% interest, you're telling me all I have to do is live to 78, and I make my money back. And what happens is, the power of interest and mortality get commingled and confused, and all you look at is that 78, and you say, I think I'm going to live to 78. I think it's a good investment. I'm going to go for it. That's great. Okay, all good. However, and remember, the 78 would probably be 81 or 82 with profit and expenses. But now you go over to, a lower interest rate, 2 or 3%. You go to 0%, for example, you got to live to 88, right? And interest rates are really low now, and you have to live to 88. Suddenly you sit there and say, wait, I have to live all the way to 88 or 85 until I finally get my money back? Yeah, no, I'll keep my money. I'll save the money. And this is the way they look at it. And suddenly when the interest rates are so low, that life expectancy becomes really transparent, and all those tables that you use with the the mortality improvement factors and all that kind of stuff becomes very, very transparent to people. And I think this is stopping them from buying annuities. It's really bad. So now I looked at, which is more important, the life expectancy. We work so hard as actuaries. How many actuaries in the room? There's a bunch of actuaries, right? Yeah. So we work so hard as actuaries, to get that age exactly right, the mortality which mortality table, what improvements do we use, and all that kind of stuff with annuities. And here I'm just showing okay, so let's just talk about a perpetuity. For my daughter in the room, perpetuity means that you just assume the person's living forever. So if I put $1 million in at 10%, 10% of $1 million is 100,000. I get 100,000 every year, but I never get the money back, the $1 million back. But that's what it is. So it's real easy. So you look at 5% and you say, oh, I'm going to get 50,000 per year forever. But how about if the interest rates weren't 5%? How long would that how long can I afford to pay as a company that 50 to people? And if you go to 3%, you sit there and say, I'd only have 31 years to pay them. Look at the power of that. So at 5%, I can pay them forever, and at 3%, I can only pay them for 31 years. Interest is really important in these calculations, and the low interest rates are crushing us here. That's what's going on. And by the way, as an actuary, I always tell myself I'm a liabilities person, I'm not an investment person. But I think we have to get more involved in investment rates and understand them a little bit more as actuaries. I just think we do. Okay, so let's move on. And if worser, if you didn't think that was a word, I'm assuming worserer is not a word either. So, and that is that people don't trust insurance companies, right? So this is from the survey that I worked on with Edelman, 7,000 people in 7 different countries. There were both these qualitative interviews by phone and the online, the quantitative one online. The qualitative one we felt helped us with the terminologies that we used for the quantitative one, the 7,000 people. And what happens is that this is just one of the many questions that we asked, and that's the positive opinion of the insurance industry. Right? The flags, if you don't know them, then ask your neighbor. I actually do know them. But anyway, you see the response there. Luckily, in the United States, we have actually the highest positive opinion of insurance. So if you think it's bad here, it's worse other places. And just to give you a reference point, I mean, what do you know as in the financial services? Banks have a horrible reputation, right? They're just horrible, that whole LIBOR thing, and then telling people, setting up fake accounts at banks and all that kind of stuff. Well, first of all, it's just overall it's 23%, but if you look at other industries, look at banking. Banking gets a better rating than insurance companies. This is just horrible. And by the way, I will tell you that these other industries, that's based on the Edelman data as well. So they're using the same techniques to get that data. This is not like a different study somewhere else or whatever it is. This is the same thing. So one of the things that's interesting that I will tell you, and I'll probably talk about a few times, is that one of the survey results, which I found most interesting, is the agents. You know, part of the trust is agents, right? So people don't trust the insurance companies. They're not paying their claims. They don't trust the agents. They're only out for commission, all that kind of stuff. So we pulled, one of the questions we asked is, you know, if you're buying an annuity, would you prefer to buy from an agent, online? How would you prefer to buy? And gave a whole list of things. 55% of the people said they'd prefer to buy from an agent. It's a complicated financial tool. I had a conference, I think it was 2 years ago. The head of all life and retirement services at AIG, so it's a big job. Kevin Hogan, you know, I worked with him, pretty good friends, a great guy. Kevin Hogan said, you know, Ronnie, we sell a complicated financial tool and we try to make it sound like it's simple, right? You need the agents, right? So the agents are important. 55% of people say they want to buy from agents. So we shouldn't abandon that line of, you know, that channel of sales. So 55%. But when I got to 55%, I didn't have it broken down yet. And what we were debating, those of us who were looking at the study, what we were debating is, it's really interesting. We were debating, okay, so obviously, when you look at the different age groups, you're going to look at the millennials, they're going to be in the 20%, they want to do everything digitally. And you look at the older people like us, and they're going to be in the 80% range. And now my big dilemma, my big question on this was, what's going to happen when those millennials go into middle age and then get older? Are they going to become more like us? Or are they going to carry that with them? And that was, you know, we were debating this. Oh, well, they're changed and we'll have to survey the gamma. We didn't have to, by the way. We didn't have to worry about that anymore. Because that 55% is flat across all age groups. So even millennials were above 50%, wanted agents. It's really amazing, right? So let's not abandon the agent line of business. You know, people need, you know, they do need some assistance and some help. And I will tell you, one of the things that this is my personal thing. I would say almost one of my recommendations is we as companies spend a lot of time on digitalization, direct to consumer. You know, how are we going to, you know, get these people to buy insurance and all that kind of stuff? Let's digitalize and make it easy. They can buy online, no application, faster, and all that kind of stuff. My personal opinion is that that's okay to attract a different part of the group of people who are maybe not buying as much. But I will tell you that I personally think we should be digitalizing our agents and giving them more tools to sell, and making it easier for agents to sell, digitalize. By the way, I was at one conference in Switzerland, you know, I was at the Geneva Association. They put together a conference, and this group came in, they said, like, we should stop talking about digitalization. I mean, that's like talking about electricity, you know, we all have digitalization. How many people own an insurance product and can reference all their data on their phone? Very few. I mean, I just got it from Northwestern Mutual a couple of years ago, 2 or 3 years ago. Still at some of the, like, I should stop mentioning companies, but I have another product with another insurance company that's based in Zurich. I won't tell you the name of the company. And you know, not only when I went over to the people and said, can I look at something online? And say, not only won't you be able to look at something online, try to get your money out when your benefits are due, right? So, you know, we should be talking about digitalization. You know, I make a purchase on Apple Pay, it goes bing, and I see on my credit card statement immediately there's a pending, you know, payment for 99 cents from Apple, you know, from iTunes or something. It's immediately there, and you can see it. But with tens or hundreds of thousands that we put into our insurance products, we can't see that stuff online. It's a black box, and you wonder why people don't trust insurance companies. I don't wonder. Okay, so what's the response? So again, I gave you the spoiler alert, not so great. But I want to tell you some of the things that are going on. So first, let's go back and see if you guys can win some more chocolate. So now, I keep saying that, what we're doing, and I think, what we're doing is, still important. So the total global financial assets in 2016, so this is total global financial assets, and then we'll get to what the insurance companies have, and to show you how important insurance is. What are the total global financial assets? This is according to the Financial Standards Board. So how many people think it's 240 million? Nobody, I hope. 7.5 billion total financial assets. No? 81 trillion? Someone's brave enough to raise their hand. Excellent. 137 trillion? Oh, we got more hands. 340 trillion? 350 quintillion? I don't even know what a quintillion is. Anybody know what a quintillion is? So the answer is 340 trillion. Does anybody know why I put 240? Now again, these have nothing to do with anything, so you have to sort of think, what is 240 million? Oh, so no, that's not true. Maybe in yen. So the answer is that if I said miles, another one for you. Oh, nice catch. So that's miles to the moon. 7.5 billion. Anybody know that number? Yeah. And what did you say? Yeah, let's see if I can do this. Put this down. Okay, that's the total population. 81 trillion. That number should ring. I mean, that number jumped out at me. Or I thought you were going to say my personal debt. No, that's the world GDP. 137 is the assets held by the banks, and 350 quintillion, I had to come up with some big number, and that's the gallons of ocean water, and now I'm going to say, we don't know gallons, we only know liters. Okay, I live in Switzerland, I know that stuff, so yeah, that's fine. It's the average number of miles to the moon. It changes. It changes. Is that right? Okay. So I'm off by 1,000. There are three types of actuaries. Those who can count and those who can't count. Yeah. So anyway, thank you for that. I'll change the slide. So as I was saying, insurance is important to the world, right? So we keep complaining that insurance sales have been flat. We're not selling enough annuities. There's a big pension gap. All these problems. You're really eating those? It's 20 to 9. Yeah. And by the way, these are actually from Switzerland, so I know you can get the Lindor balls in the U.S., but we don't send you the good chocolate, guys. We just don't send it. Okay, so anyway, let's not completely change, because if you see here, insurance corporations, we're talking about still over USD 29 trillion in assets held by insurance corporations, 8.5% of world assets. By the way, I just put the OFI because I didn't know what OFI stand for, and it's the other financial institutions. But you see that it's important. It's a lot of money. I mean, it's really, if you remember that, world GDP of 81 trillion, and you're talking about 29 trillion, it's a big number, right? So we're doing something right, guys. We really are doing something right, but we need to do more. We have to do more. So I just wanted to make that clear. And by the way, I pulled this right out of the Financial Stability Board annual statement or something like that. I don't know. They have a statement. It's very easy to get this information. So now let's talk about more about the industry response. So I'm here actually to talk about the industry response, and I'm telling you, it's just not very good. So if you look at this, you say, oh, look, annuity sales are up. But come on. Why are annuity sales up? Annuity sales are up simply because of variable annuities. And variable annuities, they're not retirement. This is an investment. It's not retirement assets. You may use the money for retirement assets, but it's not retirement assets. We shouldn't be patting ourselves on the back because of variable annuities. I think there was a study by Tim Ruick's group that came out. It's a couple of years old, but I can't imagine it's changed so much, that only 5% of variable annuities, under 5% of variable annuities annuitize. Right? So these are not retirement assets. So but if you look at fixed annuities, which are retirement annuities, fixed annuities, they're flat to declining. Right? It's not going well. I'll ask you, it's just no more chocolate on this one. How many people here have an individual, not company sponsor, individual annuity that they've purchased? Yeah, actually, we're actuaries more than I thought, but it's just not enough. We should all have them, right? So, one of the big problems to me is the word annuity. It just doesn't mean anything to anybody walking on the street. It's horrible. So my daughter's here. She's 31, and she's shaking her head. She's like, what does an annuity mean? And if you look at, there was a LIMRA. No, it was a Maddox Douglas survey. Maddox Douglas survey asked people about, and millennials, I think it was, less than 40% knew what the word annuity meant. I don't understand why we keep shooting ourselves in the foot. And by the way, we tend to make products that we would buy. We'll talk about that again. We're actuaries. We make products that we would buy, not necessarily other people would buy. So really good. And we don't even buy our own products. When I remember my first job at Mutual in New York, my boss said, hey, Ronnie, it's time for you to buy one of each product. We're an agent compensation committee. We talk to the agents all the time. You should have one of every product. And I did, and I bought one of every single. So I have a disability income, I have a term life, I have a whole life. I have one of every type of product that Mutual of New York was buying. Those are like my best performing assets. It actually was pretty good. So anyway. So now we go into the industry response. I saw the guy in the back of the room. You're from Prudential, right? You're from Prudential Financial, right? Yes? No? Yes? Yeah. Okay, good. So I'm putting a plug in for you because I love the company, by the way. So anyway, so we talked about that most of these products that they're going after are not really annuities, that they're going after wealthy people. I can prove they're going after wealthy people. I had this conversation, so 2 or 3 of you are going to say, all right, you're telling stories again, Ronnie. And that is, so I'm 61. I turned 59 and a half. I'm almost 62. So I turned 59 and a half, 2.5 years ago or so. And I have money in 401ks in the U.S., even though I live in Switzerland. I have, a good amount of money in my 401k account. Anybody else have money in 401k accounts? Yeah? Anybody else? Now, of those who have, keep your hands up for a second, have money in the 401k. How many now keep your hands up only if you're above 59 and a half. Keep your hand up. And now keep your hand up. Look around the room, see the people. Keep your hand up if you've been approached by an insurance company or an agent when you turn 59 and a half to do something with your money. Larry, someone called you? You're a lot wealthier than I am, Larry. But I have to say, I turned 59 and a half. I've got a chunk of assets. I'm a baby boomer. And nobody called me. I was like, I don't understand it. I just don't. And yes, there were these regulations that the Secure Act, there was actually an article in the USA Today on the Secure Act that was really nice just two days ago. It was really nice to see it. But the Secure Act will make it easier, and I understand ERISA makes it hard, and the fiduciary responsibility and all that kind of stuff, but we have no chance for an in-plan annuity. We have nobody coming to us and saying, hey, why don't you take your money? You don't have to pay taxes on it when you take it out. You don't have to withdraw it. In the plan, we could just annuitize 75% of it or 100% of it. And here's the rate. We don't have that option. In Switzerland, you have that option. In the UK, you had that option until they just changed that with the Freedom and Choice and Pensions Act. It was a horrible act, in my opinion. Anyway, So we're just not doing a good enough job. We're not attacking these assets which should be annuitizing. But anyway, I want to show you something that Prudential does, and I'll come back to this slide, because I really like this. So my really good friend, Amy Kessler, showed this at one of my conferences. You know Amy, right? Or you're laughing, you know Amy, right? So Amy's great, and she showed this slide of what Prudential's doing to try to market to people to annuities. And that is actually, so they actually show the person, and they have a software. Am I wrong? You have a software to show what the person will look like as they retire. So they're marketing the new hire here, but then they show what the person will look like, and they say, using behavioral economics, they can show that when a person looks at themselves what they're going to look like in retirement years, they're much more excited about buying something. So this is a great idea. One person at a time. So it's a great idea, but it's one person at a time. It's not going to move the needle. It's not the idea, but I love the idea. I really love this. Many more are doing great things. Voya, my friend Rod Martin, they do great things. Jim Morris and all the companies, they're changing. They're focusing more on retirement assets and things like that. One of these other ideas, I think this guy at Micruity, who calls me all the time, he won your. Right, in the will contest. The one I want to enter, but they won't let me enter because I live in Switzerland. So I do pay my dues, by the way, Renora. I pay my dues. So I gave Dale a hard time about this already, but at least now it's on tape. So Micruity, I'll give him a pitch. It's a pretty good idea. And this is in your 401k. You have options. Cassie and I were talking about this. You have options of what to invest in. This would be one of the things you can invest in is micro annuities. So you're actually buying a deferred annuity as one of your choices in your 401k. And you sit there and say, like, wait a second, if I take 20% of my assets that just come in and buy a micro annuity, I'm buying like, $4 a month of and then the next pay period, you buy another $3.50, and you start to see that grow. And as you start to see that grow, it also gives you an idea of how much you have per month and how much you need per month. And I think it's a good idea. I think that could catch on. I think that's a really, really good idea. So I like that one. So that's something. And of course, as we said, many companies now much more focused. I know companies are selling their life insurance business. That's why there's this whole secondary market for buying blocks of business and focusing on retirement assets. But a lot of them are focusing on these to do the money management. They're not worried about the annuitization. So, and of course the whole pension risk transfer, the PRT that a lot of companies are involved in. So it's going on. But of course, as I said, the gig economy is just going to make this problem a lot worse. Okay? I'm still really upset that I haven't gotten any calls from, and I do these presentations all the time, and I still don't get any calls. So I actually just don't get calls. I mean, that's it. When I moved to Switzerland, it was a big deal for me to keep my U.S. telephone number. It's like, I'm moving to Switzerland. I'm going to have a Swiss number. But I got to keep my U.S. number because I got to keep it open for all the calls I'm going to get. So for 8 years, I've been living in Switzerland. I have my U.S. number, and I still haven't gotten any calls. So anyway, let's go on for the industry response. I want to tell you a story that's really interesting. So I just moved to Switzerland, and I'm working for Zurich Insurance Group. And Zurich Insurance Group has a big block of 10-year level term. I hope most of you know this life insurance product has 10-year level term. It's a very simple product. Well, if you're in Canada, you know the term to 100 problems that you guys have. But the 10-year level term is super simple. It's just term insurance. Premiums are level for 10 years. Benefits are level for 10 years. At the end of the 10 years, you're done, right? So you can renew, but it's a much higher price. So anyway, this was generating huge reserves in the U.S. They had a way of getting rid of these reserves at Zurich Insurance Group, which was really, really expensive. I came from the reinsurance world. I know exactly how to do this. I structured a really, really good deal where they would save $10 million in the first lump sum of capital right away on just this small block that they had, and they said, oh, great, let's do it. But I had to call the authority in Switzerland just to let them know, as a courtesy, what we were going to do. So the idea was I was going to explain the numbers and how big the numbers were and the reserves and all that kind of stuff. But first I had to explain the product. So on my first slide, the first bullet point was explain the product. I get on the phone. They said, Ronnie, you have 20 minutes and only 20 minutes. After 19 minutes of trying to explain what a level term insurance product was, I just gave up and we had to set up another call, right? So Europe is completely different. And this is true. So I got on and I said, okay, so they said, what's the product? It's level term insurance. Here's how it works. You pay a level premium for 10 years, and if they die, you get the face amount. At the end of the 10 years, it's done. Oh. What do they get if they lapse? Nothing. 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 What do they get if they live to the end of the 10 years? Nothing. Nothing. No, nothing. Why would anybody buy this product? What do you mean? If they die, they get the... Yeah, but why would anybody invest in this product? It's insurance. It's not an investment. And you're going through this over and over. Until finally, I caught on to what they weren't getting. And I said, yeah, but for a 40-year-old, you can buy... You know, it's 1 per 1,000. What do you mean 1 per 1,000? So, like, it costs you $1,000 per year for $1 million of coverage. So you're telling me I would only have to give 1,000, and if I die, I get $1 million? How could I buy one? So I became an agent, right? I turned from trying to explain the damn thing to an agent. The guy, now they wanted to buy the thing. So now the other 1 minute I had less to explain the deal, I had to tell them, hook them up with an agent in the U.S. how to buy one of these things. In Europe, it's a different philosophy. In Asia, it's also a different philosophy. And that is, they want something in return. People want something in return. So the product I had that I bought at Zurich Insurance Group is an old-fashioned endowment policy. So I give the money in. If I die, I get the face amount. And if I don't die, I get the face amount. In short, I get the face amount, right? So no matter if I come or go, I get the face amount. But the premium is very expensive. It's a savings product. Now, with the low interest rates, people were not buying these savings products. They're buying more protection products in Europe. They're changing the culture a little bit. And I'm here to tell you that buying life insurance helps with this longevity issue. Because a lot of the problem comes when when a spouse dies, especially the breadwinning spouse dies. That becomes a financial issue. They're not saving anymore and a lump sum will help. So that does help. So that's changing. But I think this is changing. So there's this culture that's changing. Also, you see a lot more genetic testing going on. So that is very, very helpful, especially in Ethos blocks of business. I think it also helps to sell life insurance, but doing genetic testing will help, I think, with our industry. Digitalization we talked about. My big one is financial literacy. I just think that this is the most important thing that you can talk about. I don't understand why the insurance industries around the world, or let's say in the U.S., are not lobbying governments to put financial literacy on the academic curriculum in schools. I just don't understand it. And people say, oh, it'll take so long. Yeah, but if we do it now, in 20 years, we'll have it on the system. And I just think that we should lobby, all get together our companies and do this. I'm a big fan of financial literacy. I think it's really, really important. And then you see this hybrid products. They've been around for a while, but you see more of them with long-term care. I personally think long-term care is a product that needs to be a mutual company product. That's just me. I think it's very expensive and it's hard to sell, but a mutual concept is really good. Hybrids work as well. The one thing as people age and they need to work a little longer for retirement, I still think the younger retirees should be working in home care or some sort of assisted living care for the older retirees. I think that'll become some sort of an industry. I think that'll help out because it's sort of a rejuvenating thing. You say, look, let me get in this industry and help out with it so that when I become the older retiree, someone will be helping me. I think that's that. And then, of course, there's a whole new breed of let's work on prevention. Prevention is much cheaper for insurance companies than curing the diseases. And I think you're going to see a lot more of that coming out. Okay? So you getting mad at me already? I still have I have a full 5 minutes left. So just really quickly, this is something on genetics. So there are companies working on it, and the regulators' responses are not that good. The red ones are negative. The green ones are positive. But the first one is the one I really get nervous about, is that they're requiring more capital on long-term guarantees. But I just wanted to spend just 2 or 3 minutes on what the future might hold. And the one thing is I keep saying, and I'm trying to sell a lot, is that we should change the model of insurance. We really, really, really need to change the model of insurance. So let me just give you a little story of how we could do that. My mother-in-law in Switzerland, struggling between going to an old age home and living at home but needing some care or whatever it is. And she always says that, she would love to go out to dinner, but, it's somewhat expensive to go out to dinner, and she hates cooking, so, it's so much to clean up and cook and all that kind of stuff. And it's like, why do we always think about money? Why do we always, create problems that give money and throw money at people? That to me is a problem. That's what we would buy. We know what to do with money. All of us in the room know what to do with money. Most people don't know what to do with money. My mother-in-law may be a product that says, here's your annuity, pillar 1, pillar 2, whatever it is, here's your annuity. And instead of any kind of bells and whistles on it, how about 3 times a week she gets to go out to a restaurant? So there's a contractual, the insurance companies have these network of restaurants or something, gets her out of the house. We all know companionship is very important for longer life, gets her out of the house, gives her something to live for, to go out to meet people, to get something to eat or whatever it is. Why not things like that? Why not provide services? The annuity would provide someone to come and clean the house. The annuity would provide someone to do the laundry. Things like that. Why can't we get into the services thing? I think people will value services and the companionship that the services bring a lot more than a chunk of money just thrown at people. And I'm just really, really pushing this. So Jean-Marc is looking at his watch. You can read the other ones and read everything else on the presentation. But, because it will be posted at some time. So now I will open up the floor and see if anybody has any questions. So thank you for your attention.
Good morning.
Good morning, Anna.
Anna Rappaport. I have a few questions for you in terms of things the industry might be thinking about. One is the role in helping people finance continuing care, retirement communities, and long-term care generally. I realize that there are a lot of issues around traditional long-term care insurance, but financing long-term care is clearly a major issue. But then I want to change hat and ask a different question. As the population is shifting, are the companies doing something to try to respond to having an older customer base? And are they thinking about older people as agents or as employees? They're thinking about it as employers. So if you have any thoughts about those questions, I'd be interested.
So the communities is a great idea. So I think that one of the big problems with longevity is that we have abandoned with Pillar 1, the invention of Pillar 1, we've abandoned the family model. And I think that you will start to see communities have family models that are not families, right? So I do think that you'll get younger people moving into a community, not being able to afford a house, but the older person's in the house, they move in with the older person, it becomes sort of a fake family. And I think this model is really, really good. And there are some communities that are doing those things. And when you start to read about the successes of that, I think that will work out. And to answer the second question about companies moving, changing their programs, and they are. They're selling off life insurance. They're focusing on retirement. They're starting to think about substandard annuities, where they get cheaper rates for people who are sicker or something like that. So there are all these ideas. They are thinking about those things, and I think that they will help Of course, when you start to, just like with the preferred life insurance, when you start to take the preferred lives off, it makes the rest of the group a little bit more expensive. When you start to take, when you have substandard annuities, when you start to take the substandards off, it makes the ones who are remaining more expensive. So we have to be careful about that. But I think you are seeing companies starting to think about this. Yes, I agree with you that they are having that. Les?
Yeah, thanks, Les Lohman. Dragging back to the beginning of your presentation on the fertility rates, I've observed, perhaps I'm one of the only people in the room to have had a child born in Japan. And what amazed me about that was the quality of prenatal care. It was terrific. My wife was well treated. She was examined regularly. There were very few things. And I suspect that most people think that raising children is somewhat difficult. But they want to have children that survive. And my observation, which is really a survey of convenience, is that the higher the probability that a child will survive, the fewer children the family, the parents really want, okay? And so using Japan as an example, the extraordinary prenatal care, the survivability of the children, the infant mortality rate is really quite low. Well, in my case, I only had one child, and that was more than I could deal with. So I think that's related to that. And then the other thing that I think is important, I brought the issue up yesterday about the toxins in the environment. There's a lot of endocrine disruptors that now are a regular part of our diet, the air we breathe, the water we drink. And there are studies that are showing that people are a whole lot less fertile than they were. And that's definitely going to have an impact on fertility rates. So anyway, very interesting, and I appreciate
and Les, thanks for that. And I understand that anything for you gets really complicated. So one kid would be complicated, and I will tell you.
I tried to make a deal on a half a kid, and they just wouldn't do it.
And I'll tell you, Les, when
I wish I owned half that dog, I'd kill my half.
When the kids outnumber, I have 4 kids. When the kids outnumber the parents, it really gets complicated. So because they can team up on you in really bad ways. But I did mention, and it is one of the factors for sure, that the infant mortality rate is one of the direct correspondence for fertility, that families would have kids because they would be afraid that that they might not survive. So I really do think that's important. And another issue that you didn't bring up is more availability of contraception techniques. So that just lowers the amount of children being born, right? So, I guess, I had to be a mistake after my sister. I don't know why my parents would want another kid. So, yeah, it could be something like that. But thank you for the comments.
The contraception techniques really aren't so necessary anymore, given the endocrine disruptors.
Yeah, so, thanks, Les.
Hi, Kerry Pector, Retirement Income Journal. You were talking about the industry's response with the variable annuities, and that your concerns about those. And then you also mentioned the Secure Act opening up the opportunity for annuities in retirement plans. But I mean, there are good signs that the industry is going to be selling a variable annuity with a lifetime income guarantee in 401k plans, not fixed annuity. There was an effort 10 years ago by MetLife and Barclays, I think, to have a 401k plan where a chunk of your contribution every week goes to buy a few dollars of income. But that's not the product that's being contemplated. What's being contemplated is a rider that goes on target date funds at, say, age 45, and then an individual gets has a totally liquid account through retirement, but they're guaranteed 5% of the base all through retirement for as long as they live. So I just wondered if you had considered that, because I hear a lot of people taking for granted that, oh, because annuities are now going to be easier to get in plans, that we're going to have a DB-like solution in plans. But the living benefit, which is the product that's safe enough for insurance companies to give, is a very different product from the DB-like.
Yeah, so there are two things with what you said, Kerry. So thanks for the question. And the first one is that those variable annuity options are still focused and targeted to wealthier individuals, and that's not helping the masses very much. And when you see that 5% option where you multiply 5% times your assets, this is not a new concept. In Switzerland, Pillar 2, that's exactly what it is. There's a government-mandated annuitization rate. Currently, it's 6.8%. That's only on the mandatory portion of the assets that you get, which is not so much. You know, companies are free to do what they want above that, whatever is being contributed above that. But that governmental mandated annuitization rate is something I think we need. So in other words, when you say about 5%, maybe the government should say on Pillar 2, you should have the option to annuitize up to this much in assets at this rate. And if you company can't afford to do that, then we'll go to another company to afford to do that. So it's voted by the government. It's staying too high at 6.8%. They tried to get it down to 6. It will be 6 next year, I think. But I think that's a great idea. So anyway, thank you very much for your attention. And thank you, Jean-Marc.
Thanks again, Ronnie. And given that Ronnie made a little plug for the Workable Innovation for Living Longer contest, here's a chance to win $10,000. Ask your colleagues, your students, whoever you know that lives in the US, Canada, and the UK only, and not Switzerland or Germany, unfortunately. But think about that. There are flyers in the front.
And if anybody wants to buy my idea, I'm happy to split the $10,000 with them.
Yeah. He'll pay you in live chocolate. If you like this symposium, I encourage you to tell your colleagues about it, tell your companies about it. Let's try to make this symposium grow as well. Thank you very much for your attendance in this session. I'll see you in a few minutes for the next session.